everybody. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. Welcome to the show. We are back to talking U.S. economic data and what might actually move these markets, because we have, of course, had broad standstill around a whole lot of the benchmark assets that we look at. There's been some movement around the edges. Silver had a particularly bad week last week. The U.S. dollar had an especially good week last week. But a lot of the big benchmark assets, the big indications from the bond market, from the stock market, from gold, not really pointing to directional conviction. And so we are, as ever, looking for where the directional conviction might come from and where markets ultimately find the reaction function to what is occurring. And so with that in mind, we are going to focus today on the upcoming U.S. retail sales release and perhaps what it might give us by way of a lead to break this deadlock in stocks, in the dollar, in gold, in bonds, and really across the range of global markets. So let's consider here what we're looking at. Let's consider how it might be interpreted by markets, and at least what the moving parts are, so that when we get a bit of guidance from the price action in the wake of this data, we have a sense of what it is that we're looking at and how do we interpret it going forward. Here's what we're expecting. There's a bit of an uptick in the forecast where the headline retail sales number, which is the month-on-month figure, is expected to grow 0.8%. Now, that would, of course, jive with the relatively positive story that we've been seeing out of U.S. labor market data. Of course, NFP numbers just came out and gave us a relatively healthy 200-plus increase in jobs growth. The unemployment rate fell to 3.4%. So one might say, well, there's nothing really to see here. Seems to make sense. We should get a retail sales number that's broadly in line with recent ranges. 0.8% is very much in that direction. It follows a couple months on the downside, 2 consecutive months of retail sales shrinking. So should be all good news. But not everything is as it seems here, apparently. If we look at the overall direction of U.S. economic data as relative to forecast, this is the index we often look at from Citigroup, the U.S. Economic Surprise Index. It tracks data outcomes relative to median forecasts. Those typically come from the likes of Bloomberg or Reuters, which aggregate the collective market economists' perspective, or at least a large sample of them in each case. That gives us those numbers where we end up on a data release day hearing XYZ piece of data came in better than expected or worse than expected. Well, that as expected component is what we're measuring here. And when we look at the surprises, we see that when the index is above 0, that means data is tending to surprise on the upside. When we see it below 0, data tends to surprise on the downside. And of course, we can see incremental shifts going in a direction. And clearly that direction here seems to be down. So we've been looking at deteriorating U.S. economic data now for quite a few weeks. The downturn that we're looking at here started right around late March And we are now, for the first time since, let's call it the end of January, looking at numbers in negative territory. So U.S. economic data now, for the first time, let's call it in 4 months, being generous, is actually underperforming relative to forecasts, having deteriorated relative to them for about 2 months' time. So the trend in U.S. economic activity, at least as far as the data is concerned, seems to be pointing toward deceleration and some sort of a downturn emerging, at least relative to what market participants have been expecting. You can see that in the way that the markets have been responding in the wake of the banking crisis that broke out at the beginning of March and the subsequent digestion of that. So you can see that at the top there we have the 12-month Fed policy outlook. That's the 12-month Fed funds future. So it's essentially where rates are going 12 months forward from any given day. And on the bottom there is the OFR Financial Stress Index, which measures essentially what's going on with financial conditions and whether credit is being squeezed, whether credit is abundant, what liquidity looks like, etc. What you see here seems fairly straightforward on the Financial Stress Index. It surges when you have that SVB bank crisis episode, and when it doesn't then find systemic level contagion because of the quick firefighting efforts that you get from policymakers, you can see the stress eases off, and we're in a situation where we're now hovering around much more manageable levels, broadly in line with where we were essentially toward the end of the Fed's rate hike bonanza last year. So we're essentially near levels that were prevailing at the end of last year. Notice that in that same sort of period, the Fed rate hike outlook has not moved back higher, having collapsed when this stress occurred. So clearly, the market is saying the Fed is not going to change its perspective on rates from the lower levels hit during the crisis, even as the risk has come off. In other words, the market is perceiving that there is something else here that's going to keep the Fed from essentially rebuilding and pushing on with more of a hawkish perspective, more alike where it was before the crisis, even though the crisis seems to be more so on the back burner, at least for the time being. You can see where that is starting to appear in markets. So this, of course, is our go-to chart for watching how the Fed's disinflation effort is proceeding and how the markets are reading its likelihood of success given economic conditions. And the takeaway here is that the market sees meaningful pain ahead. Consider we now are looking at CPI of 4.9 and the PCE index, which is an alternative inflation measure that the Fed tends to favor, at 4.2. Either way you slice it, we're about 2 to 3% off the Fed's inflation target. Now you can see that the 2-year break-even rate, which is the market's expectation for where inflation is going to be in 2 years' time, this is derived by taking the difference between real and nominal bond yields. Nominal bond yields, of course, are what we talk about when we say the 10-year yield has done XYZ thing, or the 2-year yield has done whatever. Real yields are those yields minus expected inflation. So when we take the difference between the regular nominal and the inflation adjusted real yields, we get left as residual the magnitude of that inflation adjustment. And that tells us what the bond market expects for inflation over a given period. Here we're looking at the 2-year because that's essentially the Fed's policy window. So we can see here over this policy window, the market now thinks inflation is going to be 1.9%. That's not only meeting the Fed's target, that's actually a little bit softer. So the presumption then is that what the Fed is going to do here is not much more of anything. And we are going to have, in this 2-year period, enough of an economic squeeze that we are going to get from between 4.2 and 4.9% inflation to 1.9. In other words, there's between 2 to 3% in inflation to squeeze out, and the market believes the pain will be there to squeeze it out. That essentially this will occur without the Fed ostensibly doing very much more. It is generally the expectation around markets that the May rate hike, which we just saw on the 3rd of this month, was the last in this tightening cycle. And so therein is the sort of practical reflection of what we saw here. The reason why that Fed rate hike outlook ostensibly is not rebuilding is because there is enough pain that the markets envision over these next 2 years to get to where the Fed is trying to go. And so with that in mind, the market is seemingly already positioned for some sort of a downturn. That's, of course, incredibly relevant for retail sales, considering how much of a share of the U.S. economy is accounted for by that part of it. We, of course, constantly talk about the idea that the U.S. is overwhelmingly driven by consumption. In fact, household expenditures, private household expenditures account for between 70 and 75% of overall U.S. GDP growth, depending on when you look. It's even more dramatic when we look at it in global terms. The U.S. consumer isn't just 3/4 of the U.S. economy. It's also 16% of the global economy. So this is a huge story, not just for the U.S., but for the world writ large. U.S. GDP is about 1/4 of global growth, about 25%. Since most of that is U.S. household consumption, it works out that about 16% is the share of global growth accounted for by the U.S. consumer alone. And so we're looking at about 2-3% more inflation that gets squeezed out because of an economic downturn. Well, where's that economic downturn coming from? Well, ostensibly, the U.S. consumer, because that's where movements in U.S. growth generally occur. And if that's the case, well, that's bad news all around because of how dominant the U.S. consumer is in driving global growth, not just U.S. growth. And indeed, expectations around this squeeze are starting to show up in U.S. consumers' own reckoning of what's going on. Consider here the latest numbers from the University of Michigan Consumer Confidence Survey. What we have here, most worryingly, is an aggressively sharp downturn in the expectations index. That's the forward-looking aspect of this. You can see the current conditions index still reasonably chipper here. Of course, this entire thing has been trending lower since the Fed started its rate hike cycle and made financing of economic activity more expensive. You can see the trend since the beginning of 2021 really has been toward deceleration. We can see that, of course, that has really picked up momentum and then really only started to ease a bit toward the back half of last year as it started to feel like maybe the Fed was having some success on the inflation front, and maybe the pain was not so acute, for example, in labor markets and in other kind of immediate areas where the U.S. consumer would feel the squeeze. That squeeze is perhaps now starting to really have its impact. And it's the decline in the expectations index in that sense that's the most worrying. It should be noted that on the way into the Fed's rate hike cycle, it was this indicator that was perhaps earliest in signaling that inflation expectations were much more entrenched and not as much of a transitory thing as the Fed thought at the time. And so this tends to be something of an early lead for where the U.S. consumer sits, and thereby where policymakers ultimately end up steering, as do markets. So it does appear that whatever weakness is building in the economy, recent jobs data notwithstanding, the consumer is already feeling it and is already anticipating worse to come. This is perhaps not terribly surprising. We can see in the latest set of the ISM economic activity surveys, this is from the latest numbers by the Institute of Supply Management. These work on a PMI logic. So above 50 is growth, below 50 is contraction. The faster you go above 50, the further you go, the faster the growth. The further you go under, the faster the contraction. What you see here in the prices sub-indices for both service sector and manufacturing activity is that for services, we've seen steady disinflation, but prices continue to grow at a really significant clip. For manufacturing, you can see you had a dip into negative territory, so a dip under 50, but we've now recovered in recent months, and we're back well over 50, and so we now have positive growth. So in other words, inflation that's picking up steam in manufacturing and still positive inflation in services. So ostensibly, there's a bit more of a squeeze here recently. At the same time, that employment in both sectors has basically ground to a halt. Now, this is, of course, forward-looking, and this is based on surveys of purchasing managers, which is how you reconcile this with what you see in NFP numbers that still show you positive job creation and a low unemployment rate. This is more forward-looking. This represents the perspective of the purchasing manager staff at major companies, which tend to think about these things 6 months out, maybe longer, and have to anticipate how much to source in order to field demand and deploy the available resources to fill it. So this is ostensibly more forward-looking than what those official employment numbers are showing us. And what this is saying is that in the coming months, the expectation is that employment growth in both services and manufacturing has essentially stalled or slowed to a trickle. At the same time that consumers are being squeezed with prices on the rise. Now, again, this does not necessarily point to retail level prices. This is, again, forward-looking. So you have a picture here of what the forward-looking perspective would be in that expectations component of the consumer sentiment survey. So you can see current conditions, the index 64.5, and moving lower. In fact, all of the indices here are moving lower in tandem. The overall sentiment index, current conditions, and expectations. But you can see the gap between current conditions and expectations has dramatically widened out since this reversal really got steam. So you can see here, everything is basically aligned. Here, the gap is quite small. Here, it's opened up much wider. And the reason it has is because expectations have run away on the downside, whereas current conditions have basically stopped moving higher in any kind of serious way. So what you then have is what this starts to anticipate, which is the pricing picture, while improving, still squeezing consumers and perhaps net squeezing them harder because jobs growth has essentially stalled or is seen stalling in the months ahead. So not surprisingly, consumers are unhappy. This makes financing one's lifestyle or feeling good about one's level of expenditure that much more challenging. With that in mind, we could have a retail sales number that disappoints, in line with the dynamics that we've seen from broader U.S. economic data, as we saw it right here. And so, of course, the next question is, well, what then are the implications for the markets? Well, if we look at where we sit currently, at least as far as Fed policy expectations go, this is, of course, a good reflection of where the markets believe the business cycle is headed, and therefore what the Fed is going to do about it. We can see that at this stage, we've baked in about 61% chance of a cut by September. So if you look at that implied rate delta column, you can see there is no change in June, no change in July, and then come September, there is a reading there down 19 basis points. So that's 19 out of 25 basis points for an average rate move, which you can see in that ARM column all the way on the right. So if 19 out of 25 basis points have already been baked in, that's a 61% chance of a cut. Notice that by the time we get to November, that implied rate delta column is down 42 basis points. So at that point, one cut is already in, and we're flirting with the possibility of a second. There's about a 68% chance there that by November, we've already had a pair of cuts. So in other words, 42 out of 50 basis points already baked in. By December, that second cut's there. Now we're looking down 66 basis points relative to where we are currently. So that's 66 out of 75. That would be 3 cuts. 50, obviously already there. So 2 cuts are in, 65, 66% chance of a third cut. Come January, down 90 basis points. So 3 cuts are in. And there is about a 60% chance of a fourth. So a full 100 basis points. What is particularly interesting here is that the Fed has balked at this. The Fed is saying there's not going to be cuts, that they don't expect cuts this year. Now, we of course know the markets tend to front run the Fed, and the Fed, in much of this story, has come to see the market's perspective. The market has led it. So on the way into the tightening cycle, the Fed was saying that the inflation is transitory, we don't need to raise rates. The market said, no. You will have to raise them. It's not going to go away that easily. there's significant rate hikes that are going to happen. But now the market is saying there's a big growth squeeze coming. Otherwise, how else are we going to get from 4 or 5% inflation to 2% inflation, which the market thinks, as we just saw, is already on track to occur? Ostensibly, what we need then is a policy outlook which looks something like this to address that. So if we get negative economic data that supports this view, the question will become, well, is the Fed going to start to acknowledge it? Are we going to start to see that become more entrenched? And then what will then be the response? And of course, the outside risk is that the numbers actually buck the trend. They come in better than expected, and we get a rethink on the market side. That's probably where we get the most readjustment. Now, at least the direction of travel here for a market response seems to be more clear. And here we look at the outlook for where Fed policy rates are going to be by the end of the year. That this is the implied rate in the December Fed funds futures contract and stocks. And we can see that with the SVB episode in the middle, there has been a shift. So going into SVB and into the end of the Fed's last kind of hurrah on being aggressively hawkish, when the policy outlook has been more hawkish in its development, when we've gone from a less hawkish to a more hawkish setting, stocks have fallen. Essentially saying we have a situation here where the global economy risks being held back and the U.S. economy risks being held back by higher borrowing costs, and this is bad for risk taking and bad for corporate earnings, which otherwise would be doing okay. Then, of course, the Etch-a-Sketch that was SVB got shaken up right here. And I don't just mean to pick on SVB, but it was certainly the poster child for the start of this banking crisis that, of course, has now claimed First Republic and Signature and, to some extent, Credit Suisse. And so we've now had a change of course. Notice risk has recovered and is now stalled. The Fed policy outlook has not fully recovered to where it was, and the two are now moving in tandem. So one might surmise that if we get a negative outcome that reinforces what the markets are thinking about the general view on Fed policy and the need to keep cutting, that this red line would move lower and risk would follow. But of course, the markets are already in that direction. And so there's perhaps less of a reaction function there, unless the surprise is really dramatic and it makes it appear as though the Fed is way off sides and really needs a sooner adjustment. If, on the other hand, we get a positive surprise, that would mean the markets are wrong, and the Fed might be more right in saying that they're not going to make significant changes here. That seems unlikely, given everything else that we see here and everything else that appears to be showing us an economic downturn starting to come together in the leading data. But if that's the case, well, then we have perhaps a Fed policy outlook that starts looking less dovish, but that being a good story for risk because it relieves some of these business cycle concerns. And so at least we have a sense for how markets might react when this data comes out. It does appear, though, that at least as far as what's already priced into markets, the more violent move would happen on a better than expected outcome, whereas the flip side would need a really dramatic miss to readjust because a meaningful amount of rate cuts is already baked in, and the Fed is yet to acknowledge even that. So there is perhaps a level of particular aggression needed to get the markets to really fall off, if that's the direction that this is going. Of course, then, though, a greater degree of follow-through could be expected thereafter. Because as the markets led the Fed into the tightening cycle, so too they might be telegraphing where it will ultimately come around to being on the way out. And that is macro money for today. Thank you very much for joining me. We're here Monday through Thursday every week, right after overtime, with a friend of the show, Chris Vecchio, head of Futures and Forex here at Tasty Live. I'm on with Chris again for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday evenings at the Global Market Open. In between those appearances, I'm opining on Twitter at Ilya Spivak. Good luck trading out there, everybody. See you tomorrow. Take care.